Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Our goal with this podcast is to sit down with top market practitioners, understand a little bit more about how they approach the markets, learn about the tools and techniques that they use as part of their routines and decision-making processes, and just a sense of what they're seeing and hearing about the current market environment. Today, a great interview with a frequent guest on shows that I've done, Julius de Kempenaer. Julius is the founder of RRG Research. He's a former colleague of StockCharts.com of mine, and a fantastic market practitioner and genuinely awesome guy. Julius and I talked about his sector rotation model called the RRG, the Relative Rotation Graph. Most charting platforms, at least the good ones, feature the RRG because I would argue it's a fantastic visualization to really see visually the rotation we always talk about, right? We always talk about rotation from offense to defense, from growth to value, or some combination. Julius, I think, really paved new ground for the technical analysis community when he created what has become a very popular visualization to see visually that rotation we all think about. We're going to talk about relative strength investing. We're going to talk about how 2025 has played out, some of the rotations that we've been looking at and that we've been talking about, but Julius especially applying his RRG methodology and showing some great examples of how it can help you identify rotations as they are happening. Please enjoy this conversation with Julius de Kempenaer. Super excited to be sitting down once again with Julius de Kempenaer. Julius, a newly minted CMT, by the way. Congrats on that, Julius.
Thank you, man. Long overdue, as everybody tells me.
Long overdue, and one of those that I feel like sometimes a CMT recognizes that someone has finally figured it out. You are one that I think you've deserved the credentials for quite some time. Now we're just making it formal, but congrats. That's a big step, regardless of
Thank
when
you,
it happens.
and thank you for endorsing me.
I
Because,
was going to
as a
say, I think I had a hand in it.
yeah, you did. As a past president, yeah, that was valuable.
I'm
Thank you.
happy to do it. I'm happy to do it. So we're recording this sort of mid-December 2025. This is a natural time to kind of assess where we're at, where we've come from. Obviously with the U.S. markets, we've been in this primary bull market. We are a hair's breadth away from all-time highs. When you're looking at this market here, particularly recently, right in the fourth quarter, October, November, now December, what stands out to you? What's your general sense of things? And I guess the initial question, do you find more reasons to be optimistic or not so optimistic based on where we're at and where we've come from?
Ooh, that's a crossroad question. I I have to stick with my guns. I did a couple of videos and talked to a few people recently, and I'm still cautious.
Yeah.
And basically that happened. I'm looking at a chart on my other screen here. So until October, November, things were all pretty good.
Yeah.
The MAGA, the Magnificent Seven,
Hmm.
the technology was driving everything.
Yeah.
If you miss technology, you probably miss the market.
Yeah.
and that started to change at the end of October and basically throughout November. And for me, at that time, the rotations, the sector rotation predominantly, was starting to show a rotation that was kind of starting initial rotation out of technology. It's not like it's not done and dusted yet. We're
Yeah.
still there, but the real strength has evaporated. It just lost relative momentum.
Yeah.
And what I noticed, and it's something that I've noticed a few times in the past, and it's one of the things that I kind of learned to watch on an RRG, is when you see the markets going up, but the defensive sectors are starting to pick up. And
Right.
that is what we saw during November, and actually still going on. You saw that like sectors like healthcare, staples, utilities, they were all of a sudden starting to pick up strength. And all of that while S&P was still holding up. It wasn't rising anymore. We're back at where we were late October. And technology is kind of rotating out of favor. And that's a situation where it's like I'm not super happy with that.
Yeah.
So that is where I'm at currently. And if I look at the charts of the the S&P 500, I think there's a very distinct negative divergence between price and RSI. That is not
Mm,
negated yet. That is something that I bring in. So if I, these are all pieces of the puzzle, and if I see that rotation towards defensive sectors and that negative divergence on, if you do a weekly RRG, it'll be way more way more visible. Weekly RSI on, I mean,
oh, the S&P with the
yeah.
weekly
So
RSI.
yeah,
Yep.
the weekly chart with the week. Yeah, there you
Yeah.
go.
Yep.
Yeah.
I see what you're
Um,
saying. So yeah, so the highs September, October, November, now December, momentum kind of lagging during
exactly.
that last
Yeah.
phase. Yeah, right.
Yeah. And I always, for whatever reason, I use the 9 period RSI, which is a little bit more
Yeah,
sensitive,
right.
and then you see it very clearly. There you go. That's it.
Yeah.
There's your divergence. So, this divergence, kind of market that looks tired after a long run up, rotation to defensives. I I'm cautious. That previous high and the level that we're actually pushing against it, as you just said.
Yeah.
If we take that out convincingly with a solid break on the weekly chart, we're back in the game, and that whole period that we've seen over basically November and the first 2 weeks of December is then a consolidation within a longer term uptrend, and we probably see another lag up.
Yeah.
But I'd like to see that break, because there are right now quite a few signals, highlights, warning signals that keep me, hold my, my breath, hold my cash. Like, I don't want to be getting full on bullish here right now. I think
Yeah.
that is dangerous, and that's the good thing about technical analysis. We can just wait until we get a confirmation, and for me, the confirmation would be to have a significant break over the current resistance level, where we are really close. But
Yes.
as you know, resistance is resistance, and resistance is resistance because a lot of people are selling in that area. That's why that resistance started to show up in the first place. So
Right.
if that pattern continues, then we may need to see another move lower.
I'm noticing, Julius, in my own camera shot, I've got the bear in the background. On my other camera, it's a bull and a bear, so that was not intentional. As I'm looking, I'm like, let's not read too much into it, because I think you're right. Right, there are reasons to be a little more cautious. Some of the things you mentioned, and there's definitely been a change in the character of the market from like September, October to now November and December. Right, it's had a
Yeah.
different vibe in a lot of ways. And so I totally get that. But having said that, right, we're at new all-time highs. We're right there. So, how negative do you want to
It
be?
is, yeah, absolutely. I mean,
Yeah.
for me, what I'm thinking is, if I'm wrong, I know immediately when I'm wrong. So my
Yes.
my loss is very limited,
Yeah.
because, suppose you're fully invested and you decide, hey, this Dutch dude has something to say, and you're selling out here.
Yeah.
It's so you're only going to lose a couple of percentage points, because very soon when I'm wrong.
Yeah.
So
The charts will give you your report card right up front, right? That tells you when you're
absolutely,
wrong. So
absolutely,
it's interesting. I mean, Julius, you have created the relative rotation graph, which has become a widespread, widely followed way of visualizing rotations, particularly sector rotation. I found it valuable for years, as you know. But we're starting talking about kind of the macro level, looking at the S&P, looking at momentum. How do you kind of combine those in a meaningful way? Thinking about, and how would you suggest people do that, right? Having a good sense of, here's the overall structure of the S&P and what it's telling me. Here's the weekly chart, but then here's the rotation. How do you kind of, relate the two of those in a way that helps you then think about positioning and outlook and so forth?
you mean the price chart of the S&P with the or sorry, the price chart of the S&P with the RRG? That's what you
I
mean,
I
combining the
guess, yeah, I
two?
guess another way of saying it, right, is if people think of you as the RRG guy who just looks at an RRG all day.
Oh,
I know you're
yeah,
looking
no,
at
no,
other
no.
thing and you're thinking about how that relates. I'm just trying to unpack. Yeah, when you're
Yeah,
looking at
yeah,
the chart
no,
of the
no, no.
S&P, how do you think about that versus the rotations you're seeing on an RRG? How does that make sense?
So first of all, you can't buy an RRG, just like you can't buy an RSI or a MACD. So price
Yeah.
pays, that's first and foremost.
Yep.
RRG, and I always tell people, don't use RRG as a standalone tool. RRG
Mm,
should be part of your workflow. It's not
yep.
just like, I don't know, you whatever. maybe people use pointer figure charts in solitude, or but most people will use parts of the toolkit
Yeah.
and blend them together.
Sure.
And for me, an RRG gives me a high level overview because it shows you what's happening in an entire universe on a relative basis against a benchmark, but also against all the other elements on the universe.
Yep.
That's that high level overview. But when I see an RRG and I see some tail making some move, my first go-to is the price chart because that's where things are
Mm,
happening. So I'm looking at an RRG, and I see whatever XLV right now on the weekly RRG is inside leading, but it started to roll over the last week and a half. Then I go to the XLV chart and look like, hey, what is that? What's actually happening in
yeah.
terms of price? Because the RRG benchmarked against SPY is a relative picture. So that gives you a relative outlook. But the price eventually determines the relative, and the relative
Yeah.
eventually determines the RRG. So it all starts with price, and we can do mathematics, massage price into moving averages, into RSIs, and stochastics, and every indicator, but they all start with the price. And
Yep.
and RRG is no different. That whole visualization is based around relative strength and around a couple of algorithms. But the input is raw price.
Yeah.
So going from that visualization to a buy sell decision, I think needs to flow through the price chart, some observation, some decision point, and then you're clicking buy, sell, or whatever you do with that information. But
Mm,
as you said, not a standalone tool, not in isolation, in combination with whatever other tools fit in your workflow. And then RRG will help you to keep an eye on that bigger picture. And
mm. Yeah, well said. And I think, and to your point, I think as you alluded to earlier, what I found is if you want to understand how like July, August 2025 are different from October, November of 2025, the chart of the S&P in some ways looks very similar in that it's still going up and all of that. But the RG is where you really understand sort of underneath the hood some of the rotations that maybe are not reflected on the chart of the S&P, but tells you something's happening underneath it, right?
oh yeah, yeah. And what I also like to do is I in my own videos on stock charts, I started to use a what I call an RRG framework, or portfolio composition framework, which basically I work my way through a bunch of RRGs, starting at the top with asset allocation,
Yeah,
then do government bonds, basically the yield curve. Then I look at sectors. I can look at cryptos. I can look at commodities and find different groups that are interesting, and that basically that paints the entire picture of portfolio level. Start at asset
yeah,
allocation. Where do I want to be? Do I need to be in stocks? Do I need to diversify into bonds? Maybe I need a little bit of commodities, and then go into each asset class. So in government bonds, I have the entire yield curve. So there's 6 ETFs: Bill, Shy, IE, IE, F, TLT, and TLH, starting 3 months thing, blah blah blah, all the way up to 30, 20 years plus. I
right.
benchmark it against GOFT, which is the entire yield curve. So you got a very good closed universe, as I call it, which is the same as like for the sectors against SPY. That's a closed universe because all these sectors and all the stocks in those sectors are inside your benchmark. And
Yeah.
if you do the same with those bond ETFs, GOFT is the one that has all of those maturities in itself.
Yeah.
And I will show you exactly how that yield curve moves. And if you want to move out of stocks, which part of the yield curve do you want to be on? On
Yeah,
the
right.
longer end, you want to be on the shorter end. So
Mm.
so that is the thing. And then you can do the same for commodities. You can do the same for cryptos. And if you really want to take it to the next level, you can go into individual stocks,
Yeah.
or whatever. But
That's awesome. I'll make a point of including a link to that, a good video. I'll make sure I check with you. Get a good one where you talk about that RRG framework. I think that'd be really
oh
fun if
yeah,
people
yeah,
want
I'll
to
send you
dig
the
into
link
that
to the
further.
first one where I introduced it.
That would be
And
awesome.
then I started building on that afterwards.
Yeah. Yeah, yeah, very cool. All right, can we look at a couple RRGs together? You had
Sure.
mentioned sort of this rotation that we've seen. I 100% agree about, there was this point where it felt like technology and then everything else. Now it's felt like there's some other things happening, and I think the RRG is a really good way of visually representing that sort of change of character. Where can we start to sort of talk about sort of some of that rotation and what we've observed? This is the weekly RRG. Is that okay to start with?
Yeah, that's what I mostly use because I don't know. That's my personal preference from having worked with institutional investors like yourself when you were at Fidelity.
Yeah,
I don't I don't think you would have appreciated if I would have sent you daily RRGs and then like changing my mind every 3 days. That
too much.
that would not fly.
Yeah,
So
yeah.
uh, so what my rule of thumb for the weekly RRG is that this is kind of gives you trends that last. I always try to say as a rule of thumb a minimum of 3 months,
Okay,
and I have seen them move much longer than 3 months.
okay.
Take technology. How long is technology on the right hand side of that curve? That's way longer than 3 months. So
Sure.
that gives you a good idea about it. But what you see right now is that technology is inside weakening and it's at what we call a negative RRG heading, which is meaning that it
Mm,
is losing both in terms of relative strength as well as relative momentum. So despite the fact that it's on the right hand side, which means that the relative uptrend against SPY is still there,
yeah,
but it's losing momentum. So the question now is whether this is the start of a new downtrend, in which case you will see XLK continue its move at a negative heading towards lagging and eventually cross over.
yeah.
That would be the trend change. Or is this simply a new higher low in the making in an already established relative uptrend? Because that's what you
Mm,
see when you're inside weakening and far away to the right, which XLK still is because it's the highest ranked sector on the RS ratio scale. So all the odds are absolutely present for such a move, where you see it move out of leading into weakening and then start to curl back up. And
yeah.
that is actually if that happens, and I think that you will see that going together with a breakout in SPY above that resistance level that we just talked about.
Yep, yep,
So if you see so what is the sequence? The sequence will probably be XLK starting to curl up, move back to leading, which means that XLK, well, that technology is starting to pick up strength again. We
yep,
all know technology 36% in the S&P 500, so
yeah,
that is definitely going to make a move on the S&P chart. Bring it above that. What is that? 690. Let's round it off at 690. Um, and if that combination of things happen, that's probably going to be a very good sign, and we will very likely see another lag up in the rally going.
yeah.
Um,
It I
so
and I guess the other side of that, to describe it, it's hard to imagine the S&P and the Nasdaq having meaningful upside without the XLK doing something like that, just because of how big of a weight it is, right? I mean, it would.
I am
I
I
don't know
am
how the
going
math would even work out in that scenario.
I am going to say that that is virtually impossible.
Yeah. So
I
yeah.
don't see
So
how that will work.
But we have seen it, and that's something you shared with me years ago, which was one of, like, the most helpful conversations we ever had, was telling me about the benefits of looking for things that were rotating kind of, in this improving direction, to
Yeah,
the right side, far to the right side, that kind of rotation, which means it's outperforming, but it's just the momentum is kinda coming in and
exactly.
out, right?
Yeah.
Yeah.
So the way I explain it to people is, when you look at a relative strength line, that is just like a price chart. A relative strength line is never a straight line up. That also
Yeah.
has peaks and troughs.
Fluctuates. Yep.
So an uptrend in relative strength is higher highs and higher lows in
Yeah.
a relative strength line.
Yeah.
What you will see on an RRG, the way that plays out on an RRG is you will see leading, weakening, leading, and that's simply a relative strength line that made a high, made a higher low, and
Yep.
then started to move back up again.
Yep.
That's what you see when you see leading, weakening, leading.
I got it.
So it's absolutely possible that that's going to happen. And if you look at the RRGs, the tails of the defensive sectors now, that's one of the things that is a bit out of the ordinary of the normal observations.
Okay.
Because usually what you would see is that um, staples, utilities, healthcare would move together as a cluster. They'll be very close together. And right now, you will see that healthcare and utilities were leading. They are starting to roll over right now, which is not fantastic from a defensive point of view. It's good for the market. But
Yep.
you see that now all of a sudden, staples is starting to pick
Yeah.
up. So I still have to wrap my head around how that works, what the dynamics here are.
Hmm.
And one of the things that came up in discussions with other people is that um, we we as in the community have always seen staples utilities healthcare as the defensive sectors,
Yeah.
but over the last few years companies and income streams of those companies have changed so much that and also if you look inside the components of the healthcare sector,
Hmm.
there are a lot of stocks that could easily qualify as technology stock. There's lots of
Sure.
healthcare technology stocks.
Yep. Yep.
And even so, in utilities, there's lots of companies that provide power to AI and data centers, etc., which is why was utilities a defensive sector? Because everybody said, oh, everybody needs heat and everybody needs water and everybody needs electricity and whatever
Yeah.
else there is.
Yeah.
Whatever happens to the market, everybody will want to warm their house and flip on a light switch. I don't have the insight totally into that sector, but I can totally see with the demand of power from the grid, from these data centers,
Yes.
that the supply demand dynamics for utilities have shifted considerably, and they may not be such a defensive play anymore, but they're
Yeah.
driving the AI revolution and all the power that we need by that. So again, I am not an expert in the field, but this is my I I have to think about a Dutch about the Dutch phrase, which would sound incredibly funny when I translate that into
Oh,
English.
please do it. Okay.
It's,
What is it? Go ahead.
it's in Dutch it's called op zijn Jan Boeren fluitjes. So everybody who speaks Dutch will understand it and roll on the floor laughing right now. It translates into like um, John the farmer um, whistle. So it's like a farmer is depicted as a very simple guy who just looks at the weather. Oh, the sun is shining. Like,
Right. Okay.
oh, it's raining.
Yeah.
Oh, it's raining. Now my pasture is full of mud. Like these are this is logic and simplicity that
I
this
love it.
just so the simple guy and and so my expert level on these pretty complicated things is at that level. Like,
Yeah.
oh, there is an AI company that needs power. Maybe the power companies are selling more power to
Hmm.
those guys. That's the level where we are. Just to lay it out here, that I don't want to get all these mails of people explaining me how that works. I believe you, but
Yeah.
this is like some sort of explanation to figure out
Yeah.
like, okay,
Well,
this is why that's happening.
no, for sure, but I think what you're illustrating, Julius, is a really good point, which is the RRG often helps surface relationships that then what I found is once you see it, you go, okay, hold on, why are utilities trading a lot like technology right now? And then you can start to think about, okay, here's why, because there's a direct link. And healthcare, the same thing, right? Why is healthcare doing so well? And there's a bunch of things happening, right? There's biotechnology companies in there, which have always been
Oh
more
yeah,
offense
oh,
than defense, but
100%.
pharma
Yeah.
stocks have done really well because regulatory environment all of a sudden is great for pharmaceuticals. And so I think the value for me of the RRG has been it tells you what's happening. And then the explanation as to why these relationships are changing and why something isn't looking as defensive as it used to be. For me, this is what helps you understand that's a question you need to ask. And then you can understand maybe the implications going forward.
Oh yeah,
So,
absolutely. And
so with the
is
with
it?
the with the weekly RRG, so the healthcare is one that stood out to me, and we've definitely seen an
Yeah.
improvement. When you're looking at the RRG over time, like when does healthcare pop up, and when do you see that as okay, healthcare is a thing that's starting to look kind of interesting, and then okay, healthcare is really starting to emerge as a leader. Can you talk about that sort of rotation and like how you identify when it kind of hits your radar and so people understand how to detect sort of those improving sectors that have been out of favor and now starting to be in favor.
Yeah. So what I pay a lot of attention to the what I call RRG heading. That
Yeah.
is basically, you go back, so you have the endpoint, then you go back one node, and you'll center your compass on that previous node, and you'll see where that last node is heading. So
Yeah.
healthcare right now is probably at, I'm going to say 165, 170 degrees. 180 is due south.
Straight down. Yep.
So this is like 170 degrees, something like
Sure.
that. If you go to XLP to staples, that heading is pretty much spot on 45%. That's like,
Yes.
same. So the chart will distort it a little bit, but just
Yep.
eyeballing it, that's a positive heading. It's picking up speed on both axes. So XLP is actually strong, and XLV is now losing that relative momentum.
Yeah.
What we've learned is that a positive heading, which is defined as anywhere between 0 and 90, because then you're starting to pick up on both scales,
Yep.
is a good sign wherever you are on the RRG.
Mm.
um, Obviously, just like we discussed with XLK, which has a negative heading, but
Yep.
is far away to the right and still has the opportunity or the possibility to curl back up. If you look at XLP, it's the lowest reading at a positive heading, but that has all the possibilities to roll over and go back down, which means you're in a very strong relative downtrend, and you just made a little hiccup in a
Yeah.
little recovery in your downtrend. And when
Yep.
it starts to roll over, it basically tells you that XLP is going to continue its relative downtrend. And that is where a little bit of the art, experience, subjectivity, if you want, comes
Sure.
into play, and how aggressive do you want to be?
Yeah.
I like the direction of XLP. I don't like the position. It's, for my taste, it's way too far to the left.
Yeah.
The risk of it to roll over is too big. I would rather see it way further to the right, basically where utilities were a couple of weeks ago.
Yeah.
That's a bit of a disappointing move that we see there, but
Yep.
just to give you an idea, like 2 3 weeks ago, if you would have asked me about utilities, and which I did, it's like, hey, that's looking really good. Now
Yeah.
it's, yeah, that, so that is a very good position for utilities.
Yep.
Disappointing that is now all of a sudden starting to roll over, but
Yeah.
that's where you see the all-encompassing rotation, and the benefit of seeing everything in one place. Because if you scroll back again 2 weeks, um, yeah, yeah, something like this. Yeah, okay. So now look at utilities, looking really good. Energy, healthcare, all strong. Look at communication services, discretionary, just
Yep.
underneath, moving into lagging. Look at financials. Look at materials, pushing further down into the lagging quadrant. Now, if you now scroll forward 1 2 weeks and look at what happened, you see utilities has rolled over, but at the same time, we see that financials and industrials have rolled in the opposite direction.
Yeah.
So again, this is not like there's no signal, if you want, but
Yeah.
it tells you something. These sectors, industrials, financials, that were kind of out of favor, and to a lesser degree, discretionary, just that's only one node that is ticking back up. But for me, that paints a picture that things are moving around, and
Yeah.
that's what triggers me, and that was keeps me going. Like, oh, now I want to see what's happening in the financials chart. So I bring up the financial sector. Now I want to see what's happening
Mm.
in healthcare, and I bring up the
Yep.
financials or the
Yeah.
healthcare price chart. Utilities, very interesting now. Why is that turning around? So I bring up the utilities chart, look at the utilities in combination with the relative strength line versus the S&P 500, and make up my mind. Like, is this something that I'm worried about? Is this breaking levels? Is there a price pattern? Is it breaking about below moving averages? Is it, I don't know, whatever other stuff that I want to have in my toolkit.
Yeah.
Um, and that's why I always tell people you can use RRG with whatever workflow you have. If you are an Elliott wave analyst, you
Hmm.
could use an RRG and look at XLV and say, hey, is this a fifth of the fifth? Is this starting,
Right.
a new corrective move? If it's in lagging, have we finished the final wave 5 down, or that kind of stuff? If you're, I don't know, if you love point of figure charts, you bring up point of figure chart. What's happening on my point of figure chart? If you're trend following price reading charts, then like what you and I do most is you bring up a price chart and maybe one or two indicators, and you look at what the trend is, and bring in your preferred moving average, your preferred indicator, your, I don't know, whatever you like.
Yeah.
But they can both or all be fed from an observation made on an RRG, taken to whatever the personal preference of an analyst or an investor is.
Yeah. No, that's well said, Julius. And it's funny as you're describing, it's just that exercise of putting things into motion a little bit. I know from using RRG on a number of different platforms, Optima and stock charts and Bloomberg even, I found once I start kind of tweaking, maybe just look at a couple weeks and putting them into motion, that, experimenting with some of the different looks, you kind of, for me,
Yeah,
I kind of found the one that, okay, that's, if I look at that consistently, I'm really going to get a sense of what's evolving here. Well,
yeah.
it's really well done, Julius. So, I mean, this was awesome. This is such a great little run through the RRG and how you're kind of looking at them now. For those that are kind of less familiar, and I can't imagine some people have not used this platform yet or have used the RRG enough yet, but for those that are just kind of learning about it, what would be your tips or tricks or words of wisdom if you're just new to this visualization, and how can you kind of help incorporate it into your workflow?
Okay, so first of all, shame on me. I should have written a book. Tons of people
I was
have
gonna say,
asked me
where's the
about it.
book,
Yeah.
Julius? Like, come on.
It's in my head,
There
and
you
it needs to get out. I know.
Yeah,
But having said that, for now, I'm going to say the blog that I write on the Stock Charts website
yeah,
is a pretty good go-to, especially if you go into the history of that. There's tons of
yes,
more educational articles in there as well. Same with the videos. If you go on the YouTube channel of Stock Charts and you just type in RRG, you'll find tons of videos. There's most of them are market commentary, opinion type videos, but there is a ton that are RRG 101 and specific use cases or implementations of it. Optima obviously also has a great website, has a great implementation of RRG in their program. They're a desktop piece of software, so they got lots more possibilities, and
sure.
you can use it if you're more quant orientated investor and you would like to do your own scripting and use RRG values in your workflow. Then Optima is probably your go-to platform, because you can use it into if this then that type of searches and alerts and back testing, even you can use it for.
And Optima
um,
has some of those things coded, like the direction of
yeah,
the
yeah, you
arch and
just
all of
make
that
it, you,
kind of
you can
stuff.
immediately make a call on
Yeah,
that, RRG heading,
it's pretty cool. Yep,
distance from the mean, and all of
yeah,
that. That's all there. So that's pretty powerful. It's a different price level, but it's pretty powerful stuff.
yeah,
Um, yeah, so that's it. The RRG website, the relativerotationgraphs.com, which has a lot less. I point to a lot of stuff on stock charts on Optima, because
sure.
why would I write it again if it's already present? Yeah, so please go there if you're not a user of stock charts nor Optima. There is a small RRG online, we call it, implementation,
Mhm.
where we cover just a few universes with very limited functionality, but it gives people a sense of what's going on, and gives you,
Yeah,
an idea of you can't customize it, you can't put in your own ticker symbols, you can't put on whatever, can't change the benchmark, which is a big thing in RRG, but it gives you a good idea.
yeah. We'll include some of those links, so if people are trying to dig into it and learn a little bit better, they'll go to the right places. Julius,
Absolutely.
write that book. That would be so fun, and I would love
Yeah,
nothing more than invite you on for a nice book launch discussion, and we can talk about the nuances of it. So, good luck
yeah,
with that whenever you make time for that one. It's a process.
maybe that should be my goal for 2026,
There
right?
we go.
So,
There we go.
so
Put it on the list.
are you now doing what Tyler did to me in Tampa with my CMT3? Are you now
Just
like putting me
peppering
on?
little
Just
subtle hints, and then
yeah.
eventually you'll do it. Hey, listen, this was awesome as always, Julius. It's a pleasure to chat with you. Thanks for walking us through some of your process and takeaways. Have an awesome holiday season. We'll circle back in the new year, okay?
Absolutely, man. Talk soon.
I have to wholeheartedly agree with Julius's general assessment there, and his starting with the weekly chart of the S&P, just thinking about the transition, what we've called the change of character from how the market looked in Q3, right, in September and then into October, and then how things have changed quite a bit in Q4, in October, November, and now December. That rotation we've seen in a number of different ways, right? We can see it on that weekly chart of the S&P with declining momentum. We can see that certainly with the RRG, the relative rotation graph, and looking at offense to defense and how that started to change. When you think about sectors, and as we had mentioned, you often think in those default buckets, and I'm certainly guilty of this, right? You sort of group the sectors for me into three buckets: growth, the offense or growth, with technology, communication services, and consumer discretionary, kind of value, traditional value sectors, economically sensitive sectors like energy, industrials, materials, financials, and then the classic defensive sectors, the low volatility, higher income plays like real estate, consumer staples, utilities, and then healthcare. But I think my discussion with Julius really helped reinforce how those are not these sort of static groups. There's some fluidity, right? To fluid nature to how I think you can define those, right? Healthcare at times has taken on a very offensive sort of a characteristic, and utilities are trading more like a growth stock, right? Trading more a little more offensively than defensively recently. And so, they're not hard and fast, right? Themes will kind of come in and out, and that's where you have to remember that markets and sector rotation doesn't happen in a vacuum. It's certainly part of that macro story. I had, one of my Market Misbehavior premium members had asked me to interview Julius de Kempenaer, particularly to get him to kind of talk about how he uses the visualization. I appreciate that suggestion. I hope we were able to get there with this conversation. My goal with the second half of our discussion was just to sort of, be the mouse in the screen while Julius kind of explained how you can use the RRG methodology, because a lot of the things that I take for granted and use often are things I've learned from Julius over the years, suggestions that he's made, or just in experiences using the RRG. Really appreciate, I think that, institutional investors I've found often think a lot about relative performance, because that's honestly how you're paid. If you're at a mutual fund company, your compensation is tied in some way to your ability, your funds or the funds you work with, to outperform, do better than the S&P. So focusing on relative strength is so meaningful. And Julius and I both have spent years working with institutional investors where that's a focus. With individual investors, I find that is an area of technical analysis that is underappreciated and undervalued, and I hope this conversation helped to change that a little bit in your mind. If you're an individual investor, if you're a financial advisor, hopefully this focus on relative strength helps, especially how Julius talked about combining that with other disciplines. Thanks again to Julius de Kempenaer of RRG Research, joining us from the Netherlands at an awkward time, but he, like a champ, always comes to play, and I appreciate it. Folks, that'll do it for this episode. By the way, if you want to learn more about some of the tools like relative strength that you can use to better improve your market awareness and understand what's working and what's not, our Market Misbehavior Premium memberships could be a great opportunity for you to upgrade your own decision-making as a gift to yourself around the holiday season. 3 great benefits to the premium membership. First off, all of our virtual courses like Flight School, Behavioral Investing, and Market Misbehavior on demand. Our reports that are only for members, our weekly flight plan, our monthly chart review, and lots of little random market updates when I see a chart worth noting. Finally, full and immediate access to our member community. That is a wonderful place where you can ask questions, you can make mistakes, you can get help from fellow investors who are like-minded about charting and technical analysis. And I'm in there every single day looking for questions, sharing quick video snippets to help explain different items and resources that the questions draw me to. You can find out more about our premium memberships and sign up today at marketmisbehavior.com/premium. Please do me a favor and use the code PODCAST when you check out for 30% off your first 12 months on any plan. That'll do it for this episode. My name's Dave Keller here with Market Misbehavior, reminding you it's always a good time to own good charts.